Okay, good morning. Today we are going to be talking about Chapter 6. We are, in terms of what's due this coming week, coming up, Saturday we have an attendance quiz due and Chapter 6 homework in my accounting lab. Video quiz 15 over Chapter 7 is due Sunday. I do want to give you a heads up. Chapter 6 is, I consider to be, it's one of my favorite chapters, but that said, it's also one of the most challenging chapters for students. This homework is going to take longer than some other chapters, so you want to allow plenty of time. Don't rush through it. It is going to require really thinking through the material, and it's challenging, and I've got some real basic examples we're going to go through today. But before we get to Chapter 6, I do want to give you a heads up. It feels really early to talk about this, but actually it isn't. Exam 2 is coming up. It covers Chapters 5, 6, and 7. So this week we're doing Chapter 6. Next week we're doing Chapter 7. The reason we're having the exam next week, two reasons. This material in Chapters 5, 6, and 7 is a little more challenging, so I don't want to put too much on the exam, so we have the 3 chapters. And that second exam is right before the drop date, so I want to make sure you have adequate information if you are in that position. The exam is March 18th through 20th. If you are in Sections 5 or 6, you can schedule with ProctorU at any time. Yes? Next week's Chapter 7. Yeah. But yes, it's 2 weeks from now. The exam is. So Chapter 6, thank you. Chapter 6 is this week. Chapter 7 is next week. And then the exam is the week after. So we have the 3 chapters to do. And again, if you're in Section 5 or 6, you can schedule your exam with ProctorU. You need to do that at least 72 hours in advance, but you could schedule now, then you'll get your choice of time slot. Okay, so that's pretty much it on announcements. We are now going, what does drop date mean? There is a date, a withdrawal date. I call it withdrawal date. Did you get it? Okay, I'll let Brian deal with it. Yeah, withdrawal date is just the last day that you can withdraw from the class and not get a grade in the class. Your transcript is marked with the W, and as long as you don't have more than a few of those, it won't affect you. But after that drop date or withdrawal date, then you are stuck with the grade. Now, just so you know, this class is a 20,000 level class, so if you don't get the grade that you want and you retake the class, when you retake the class, the new grade replaces the old grade in the calculation of your GPA. Okay, now we're on to Chapter 6. And again, this can be a challenging chapter. Inventory methods and cost of goods sold. We're working our way down the balance sheet. We've talked about cash. We've talked about investments, short-term investments. We've talked about accounts receivable, about notes receivable, and then the next thing down, we're still in current assets, but the next thing down is inventory. Inventory is what we hold for sale to customers. And then the corresponding inventory is on the balance sheet. Cost of goods sold is the expense on the income statement. Now this chapter is a long chapter, but we are not doing every learning objective. And in the video lectures, we're not doing like learning objective 4 or 5. So if you don't need to worry about those 3 learning objectives. So we're doing 1, 2, 3, and 6. Okay, now as I started out with on the intro page, things to know. Inventory is an asset. Assets are found on the balance sheet. And cost of goods sold is an expense. It's that expense that doesn't have the word expense in it. And it's found on the income statement. Now I have a couple questions to get us started, and this relates back to the videos you've watched. So the first question, True, false. Inventory is presented on the balance sheet. So inventory is an asset. It belongs on the balance sheet at the selling price of the item. Is that true or false? What do you think? False. Okay. What do you have online? Okay, Brian says he's got slightly more falses than truths. And the answer is indeed false. And the reason it's false is that word selling price. When we carry inventory on our balance sheet, meaning we put it on our balance sheet, we carry it at our cost. We don't carry it for what we're selling it for. It gets carried at the cost of the inventory. And we're going to talk a lot more about that this morning. What do you need? Oh, okay. Then we have one more question, and then we're going to get into something else. So one more question kind of related to that. Sales revenue is based on the blank price of the inventory, while the cost of goods sold is based on the what of the inventory. What do you think? D? Okay. What do you have, Brian? Mostly D. Okay, and that is indeed the answer, D. Sales revenue. When we sell something, we record the sale at the selling price. Cost of goods sold, though, when we're looking at how much something costs, it's based on our cost. So the answer is D. Next up, we have a list of abbreviations. I just want to set you up because I'm going to use a lot of abbreviations and actually the same ones over and over. So over today and Thursday, knowing these abbreviations will be helpful. So first one, beginning inventory, we'll abbreviate it BI, ending inventory EI, and then cost of goods sold. Cost of goods sold, common abbreviation to use COGS for cost of goods sold. You won't be tested on these abbreviations, but sometimes it's helpful because there'll be a lot of writing we're doing. Brian, you've called the telephony number before, and isn't there an option in the number itself on what you have to press to mute your line? Because it's not a silence your device. But if you're using the telephony number to call in for audio, when you first call in, they do say to mute your device. So you want to be sure if you're using that phone number to mute your device, because otherwise everyone else using that number will hear all the chatter from everyone. So mute your device per the instructions in the telephony given. Okay. Okay. So those are abbreviations. Now we're going to get into the real stuff. So I'm going to start talking about inventory. And when I want to start here, it's going to be some really, really simple examples. But I think it's really worthwhile to think about what we're doing, because if you understand the concepts, the rest of this becomes a lot easier. So we're going to start with a very, very simple inventory example. Okay, let's say we have T-shirts. We sell T-shirts. And we started this year, let's say this year or this month, whatever, we started the period with 3 T-shirts. So that's actually our beginning inventory. And then we bought 2 more. So I'm keeping these numbers super small so we don't worry about the math. So let's just say we started with 3 T-shirts in beginning inventory and we bought 2 more. Okay, so the first question is, how many T-shirts are available for sale during the period? How many T-shirts can we possibly sell? And I think that's pretty straightforward in terms of understanding that. We have 5 available for sale. Every T-shirt that we sell has to come from one of 2 places. Yes, the same number. Okay. Every T-shirt we sell has to come from one of 2 places. We either had it in beginning inventory or we purchased it this period. So every single T-shirt we sell has to come from one of those places. Our total T-shirts available for sale are the addition, a summation of what we started with at a beginning inventory plus what we purchased. That is a fundamental concept in inventory. When we talk about inventory, it's easy to lose sight of that, but that's one of the fundamental concepts. Okay, so now let's ask another question. Let's change the question. Let's say we sell 1 T-shirt. Okay, so we sell 1 T-shirt, and the question becomes, how many T-shirts are left in ending inventory? Okay, so we sell 1 T-shirt. How many T-shirts are left in ending inventory? And that one, so what we've been able to do here is we know our beginning inventory. If we put some accounting terminology on here, our beginning inventory was 3. We bought 2 more, so we had total available for sale of 5, and now we sold 1, so our ending inventory is 4. Okay, so those are the basic concepts. Now what I'm going to do is I'm going to put up there's probably a few formulas or structures that you need in this chapter, and this is the first of them coming up. And it deals with this exact example. We've just walked through it. It looks a lot more overwhelming when it's just in words, but we just went through it. So, okay, so beginning inventory plus what we purchased gives us what we have available for sale. If we subtract what we sold, that will give us ending inventory. So what I've just done right here is put it in the income statement format, or cost of goods, the format to calculate how many we have in ending inventory. So that you have to think of that T-shirt example. These are not, it's not hard to understand, but I think it becomes a lot harder when we put bigger numbers on it or don't use numbers at all. And we're going to see this over and over again. So this is a basic inventory calculation. So if we know what we started with, we know our beginning inventory plus our purchases, and we subtract what we sold, that gives us how many are ending inventory. Now I'm going to go back to our t-shirt example, and I'm going to modify it slightly. Okay. And now we know that we started with 3, and we bought 2 more. So that was our basic data set. We haven't changed it. But let's say instead of telling you I sold 1, now I say we've completely changed the facts here. We started with 3, we bought 2 more. Let's say we have 1 left at the end of the year. So we have 1 left in ending inventory. So how many did we sell? Okay. So that question about how many did we sell, we're solving for something different. How many we sold? So if we have 1 left, we started with 3, we bought 2 more, so we had 5 available. We have 1 left. That means we had to have sold 4. All of our available for sale has to end up either as ending inventory or it was sold. So what this means is, with this particular set of circumstances, okay, I'm going to switch slides here for a minute. Okay, so what we just did, the t-shirt's going to go away, but the formula is going to stay. What we just did was a way of rearranging the first set of structures we had. Okay, beginning inventory plus purchases gives us available for sale. So that's what we started with. When we were talking about the t-shirts, we had 3 t-shirts to start with. We bought 2 more. That gives us our available for sale. So now what we've done is we've said, okay, instead of saying we sold how many and solving for ending inventory, I can say, let me count how many I have left, and that will tell me how many I sold. Okay. So on the left-hand side, we're solving for number of units sold, the cost of goods sold. On the right-hand side, the purple box, or the purple area in the right-hand lower corner, that's when we're solving for ending inventory. This is exactly the same thing. We just rearranged the terms a little bit. And when we think about the t-shirts, that first part, what we start with plus what we purchased, that gives us the maximum we can possibly sell. And then all of those units have to end up in either ending inventory or sold. And if it's sold, we call it cost of goods sold. These 2 structures right here, I guess I could call them formulas, are key in this chapter. Absolutely, positively. This is a have to. You have to have these. On that reference sheet, I would be putting both of these down. Right now, we're focused on number of units, and that's fine. Later on, we're going to put some dollar values, but the items are still going to be the same. So instead of saying number of units sold, it'll just be cost of goods sold. It'll be a dollar amount. This is right now we're focusing on the number of units. Later on, we're just going to be putting dollar values on here. And these are schedules that go in to help calculating the cost of goods sold on the income statement and calculating ending inventory on the balance sheet. So these aren't formal parts of the statements, but they are supporting schedules for those statements. Okay? So these are really the same 2 statements, just kind of rearranged to solve for different things. So these 2 items, I'm going to take it as a given that you have them beside you. So this is how we ended up getting those. We're going to use those. Right now we're dealing with number of units, but pretty soon here, like in the next slide, we're going to use these same formats using dollars, and I'll show you how we're going to do that. So let's go back to our t-shirt example, and now we're going to start putting some dollars on here. Okay, so we have this basic inventory formulas. So let's assume that we purchased t-shirts for $10. We are dealing with inventory and cost of goods sold. So inventory is carried on our balance sheet at the cost. Cost of goods sold, the expense associated with that, is our cost as well. So we can ignore the selling price for the moment. The selling price goes into the calculation of sales revenue, but that doesn't have anything to do with inventory. We always record inventory at our cost, our purchase. Okay, so let's assume in this example we're doing that t-shirts can be purchased for $10 each. We're not going to have any cost increases, just $10 each. So if we start putting some numbers in here, we have our beginning inventory costs $10 each, so our beginning inventory is going to be $30. Our purchases are $10 each, $20, so we have no price increases. So our available for sale would be $50 because we have $30 in beginning inventory, $20 in purchases. Now, ending inventory, so we have $50. See where I get the 50? I take the beginning inventory plus the purchases, get $50. And that's my available for sale. Now, let's cost out ending inventory. Ending inventory, I have one unit at $10. So my ending inventory is $10 cost. My cost of goods sold, I have 4 units in cost of goods sold times the $10. And then what I get is if I add the $10 cost of ending inventory plus the $40 cost of goods sold, I get $50. Okay? So notice what has happened here. My beginning inventory plus my purchases equals $50. Okay? That equals my ending inventory plus my cost of goods sold. That's also $50. That will always be the case. Always. Okay? Total cost of beginning inventory plus purchases will always equal total cost of ending inventory plus cost of goods sold. That is one of those key things you need to know as we move forward. That will be something we rely on. Okay, so we have that beginning inventory plus purchases total will equal the ending inventory plus cost of goods sold total. It's the same with the number of t-shirts. When we were back on the, just looking at the units. The 3 units of beginning inventory t-shirts plus the 2 that we bought is 5. The 1 in ending inventory plus the cost of the sold ones of 4 equals 5 as well. So this will always be the case, and we're going to use that when we do some of these calculations. So I would say that little blurb in the little box in the left corner, that's quite important, along with those inventory structures that we talked about. Now, so right now it's been pretty straightforward because there was no price increase. We always bought t-shirts for $10. The cost never changed. And if that were the case, we'd probably be done with the chapter now. Okay? So because of changing prices, the rest of the chapter exists. And this is really where it gets pretty challenging. Okay? And I'm going to try to show you the issue that we have. Okay, so we're going to our t-shirt example, but now we're going to change the facts a little bit. So we're still going to have the same number sold and all of that, but now what we're going to do is we assume the price, and when I say price there, I'm referring to the price that we're buying it for, which is our cost. Remember, we're not dealing with our selling price right now. We're dealing with the cost, the purchase price is what I'm referring to there. Okay, so assume that price of t-shirts can fluctuate. So now our beginning inventory, I'm telling you, these are the facts given to us. Our beginning inventory is $10. We bought those 3 t-shirts for $10 each. Now, we purchased 2 t-shirts during the month, and unfortunately, t-shirts had a price increase when we buy them. So now they cost $15 each. Now, so we have 1 t-shirt in ending inventory, and we have 4 t-shirts sold. Now let's assume that our t-shirts are all exactly the same. Okay. Do we put inventory tags on a t-shirt? No. Okay, so we know we have one t-shirt left. We have 4 t-shirts we sold. So the issue now becomes, in our little example here, is that ending inventory. Is it $10 or $5? And the number of units sold, are those $10 or $15? And that is the huge issue with inventory. Because our costs can change for new units coming in versus what was in there already, we have this issue. And every retail company has this issue because inventory does fluctuate. So you're left with, how do we value it? Now keep in mind, we want everyone to play by the same rules. We want everyone to report the same, so that when I pick up, for example, Amazon's financial statements, I can compare them to Target's financial statements because I know they're using the same inventory assumptions. There are huge impacts on the income statement and balance sheet depending on what I answer here. Cost of goods sold, for example, that bottom line, cost of goods sold is an expense on my income statement. Now, I have 4 t-shirts, so I can either value those at $40, the $10 price, so I can go 4 times the 10 and get 40, or I can value them at 60, which is the 4 units at $15, or I can value them at something between there. So what I'm saying here, I have a choice of my cost of goods sold being between $40 and $60. Now this is a very minor little example, but if I say to a corporation with millions and millions and millions of dollars of inventory, go ahead, you pick what you want to value your inventory at. Our income statement's going to be off. Okay, how can we compare one to another when they can basically choose the expense that goes on their income statement? Because cost of goods sold is tied to how much we're reporting on ending inventory. Because no matter what we do, I'm going to show you what, I'm getting ahead here. No matter what we do, that beginning inventory plus purchases has to equal ending inventory plus cost of goods sold. And there's actually 4, so this is just a rehash of that first one we had. And this is actually, so we know that ending inventory for our t-shirts is going to be somewhere between 40 and 60. And there's 4 different methods companies can use, but they pick a method and they remain consistent with us. And so now, what the rest of the chapter, for the most part, is going to be about, and this is the most challenging part of the chapter, is about how do we value those t-shirts in ending inventory, how do we value them for cost of goods sold. And there are 4 inventory methods for assumptions. I call them methods because there's basically 4 assumptions we make. Now, I have to hasten to tell you that which method you pick doesn't have to reflect what's actually going on. And I have some caveats. So we're going to get through the 4 methods, and then I'm going to talk more about how a company would choose which method they use. So what I'm going to do is I'm going to talk about a method, and I'm going to illustrate a product that acts like that method's costs work, but they don't have to use, the manufacturer of that product doesn't have to use that method, which we'll get to. But let's just, I think these examples are helpful in visualizing what's going on. Okay, first inventory method. So we have 4 inventory methods. The first inventory method is called specific unit or specific identification. This one is the easiest, okay? This one says we have unique items. We have items with serial numbers that typically are big dollar items. Okay, now specific unit or specific identification method, something to note right off the bat. This is the one where companies can only use it if they have the right product. Okay? So if you're a company processing milk, for example, there's no way you can use specific unit. Plus, it would be very ineffective. If you're Hershey's chocolate and you're making Hershey Kisses, you are not going to use specific unit for Hershey Kisses because it would be awful to try to track the cost by each Hershey Kiss. That just isn't economical. It's not cost effective. So specific unit is typically used for big dollar items. A jeweler with jewelry, that's going to be specific unit. When they build Boeing aircraft, that's specific unit. Typically with automobiles, they use specific unit because they have serial numbers and they can track it and it makes sense. So specific unit is a little bit different than the rest. We know, we're told, well here, we can actually trace which one we sold. We know which ones are in ending inventory. There's no opportunity for manipulation there. So specific unit can only be used in very, very narrow circumstances, and this is the one method that is dictated by the product. Okay? Now, so other than this method, the other three methods a company can pick and choose what they want to use, but once they pick one, they stick with it. Okay, next method is average cost. The average cost method, this one's not bad either. This one, conceptually, average cost in our t-shirts, what we would do is take the total cost of all 5 t-shirts, divide by the 5 units, and then we get an average cost per t-shirt. Okay, so average cost is not a bad way to go either, except when you start thinking about, well, what's my average cost? You keep track every year. This isn't just 1 year for average cost. You've got beginning inventory and what years is that beginning inventory from, etc. So average cost, total cost divided by total number of units. So that's pretty conceptually easy. Then we get into the other two that are a little more challenging. The first one is FIFO. FIFO means the first units purchased are the first units sold. So first in, first out. Okay? And then the last method is LIFO, which is the last units purchased, the most recent units purchased, are the first ones sold. Now what I'm going to do is I'm going to give you an example of a type of product that conceptualizes the cost flows with each of those methods. Okay, so let's start with specific unit. I mentioned this before, but believe me, Boeing uses specific unit for its inventory of aircraft, okay, and the engines for aircraft and things that are big, okay? So specific unit, this is the one that's a little different than the other three in that you can only use specific unit if you have big, usually big items, big ticket items that are uniquely identifiable by a serial number, and it also makes sense to track them on that specific level. So specific unit's a little bit different. You can only use it if it works for your product. Now, average cost. Now, the other three methods, companies can pick the method they're going to use and then they stick with it. So you don't switch from year to year. You pick the method, you disclose the method you're using. So if I look at Amazon and Target, they're probably, I'm guessing, using FIFO inventory method. I have not looked. I don't remember what they're using. I knew at one time. But they're probably using FIFO, and they're going to stick with it. And so I know that Amazon and Target are using the same methods, and then I can compare them. So regardless of the underlying product, companies can pick to use any of these methods. But there's a couple products that lend themselves to kind of describing this cost flow. The first one, average cost, I like to think of that like a cereal manufacturer. Cereal manufacturer, they put all the ingredients in there. They're going to divide by the number of boxes or cases they made and come up with the cost. So average cost, when we think about it conceptually, a cost flow, thinking about a cereal manufacturer does have some merit in terms of visualizing the cost flow. Okay, now FIFO. FIFO says the first units we have in are the first units we sell. And a product that symbolizes FIFO is milk. Think about how they sell milk. When you go to buy milk, you buy the milk that's in the front of the dairy case. That milk is going to be their oldest milk. Their newest milk's in back. The reason they don't keep putting the new milk in front of the old milk to sell is over the course of a couple days, they're going to have old milk in the back of the dairy case that never gets sold, and then it'll spoil. So they have to sell their first units first, and so when they're selling milk, they're continually looking at a FIFO cost flow. And then finally, LIFO. LIFO feels kind of weird because we think, well, the most recent units we sold are the first ones the most recent units we bought are the first ones we sell. A product that symbolizes LIFO would be salt for road salt. If we think about how they have to use road salt, think about that. They buy it and they keep buying more, and the new stuff is piled on the outside on the top of the dome. So when they go to use road salt, they're using the newest stuff first. They don't get into that old road salt unless they've used up all of their prior. But they could, in theory, carry this core old stuff continuously forward in the future. Now, if I'm a company and I have milk that, well, let's say I have road salt. I can use FIFO method. I can use LIFO method. I could use average cost. My product doesn't dictate what method I use other than specific unit. But we are saying to companies, pick a method and stick with it, and then it'll all work out the same over time. It is timing difference, but just stick with the same method. That said, there are very valid reasons companies choose the methods they use, and we're going to talk about those more on Thursday. LIFO is only acceptable under U.S. GAAP. It can't be used on an international basis. And we'll talk, this is really which method we use is a conversation more for Thursday than for today. But what we're going to do now is, before we go any further, we're not going to use average cost too much. So I do want you to try a quick little question on average cost. So I'm going to put a question up here, and you have to calculate the average unit, the average cost per unit on this question. Oops, I'm ahead. Okay, I forgot I had this. This is a great summary. So before we get to the question, this is a great summary of what we just did. Under FIFO, our oldest units are in expense, and our newest units are in ending inventory. And then the reverse is true for LIFO. So this is a good summary to put off to the side on your reference sheet because we can ask questions that utilize this. And you can also reason your way through, but sometimes it's easier to have it written down. Okay, so this is a great thing to put on your reference sheet, and we will refer back to it. Now we're at the question where we're going to calculate average cost. We don't have a lot of homework on average cost, so I did throw a question in here. Average cost is pretty straightforward. Unfortunately, most companies use FIFO or LIFO, so those will take up most of our time. But we do have this question coming up, so I'm going to pause for a minute while you write it down. When it finally appears, here we go. Okay, a company has a beginning inventory of $40,000 and purchases during the year of $110,000. The beginning inventory consisted of 3,000 units and 7,000 units were purchased during the year. So what's the average cost per unit? So again, I'm going to go quiet for a few minutes. How are you? You look cold. Yeah, like by March.
Yeah.
Yeah, I think we have another month.
Yeah.
Yeah, but they said next week aren't we supposed to get to like the 40s? Yeah, I guess we'll be out in shorts. Yeah. Do you have an answer to that? Okay. Do you have an answer? Okay. See? Okay. Yeah. You have answers online? 21 C's. Okay. Yeah, it is C. We'll talk about it'll work out evenly. Let's see what happened here. Okay, it is C. And how we get to C is you take your total cost. Your total cost is going to be your beginning inventory plus your purchases. So you take that 40,000 plus 110,000, and you divide by your total number of units. Your total number of units is your beginning inventory is 3,000 and your 7,000. So once you take the it's 150,000 in the top, and you divide by the total units of 10,000, you do get $15 as your average cost per unit. So then if you told me that there were 5 units in ending inventory, you do 5 times the 15. So it just becomes a simple multiplication then. Like I said, we're not going to do a lot with average cost because it is a matter of taking the total cost dividing by the total number of units. But what we're going to focus on is this idea of FIFO and LIFO, and we will do average cost some. But that was a good beginning. So what we're going to do now is we are going to get into the first exercise. This first exercise, I know the LIFO stuff and FIFO stuff can be really challenging, and you have to go step by step. You have to write it down. Once you start doing one calculation in your calculator and then another one in your calculator, it becomes very hard to keep track of things. So the first thing we need to do is write down things. So we're going to start with the homework exercise. We're going to start with short exercise 6-3. And this is on the homework, and we are going to step through it. There are very few shortcuts. After a while, you may find some shortcuts that work for you. In the beginning, I think it's helpful to go through step by step. So in this exercise, we're actually doing average cost method, FIFO cost method, and LIFO method. It tells us that sporting goods stores started March with an inventory of 9 sets of golf clubs that cost a total of $1,350. So all 9 sets cost this total. During March, they purchased 27 sets of clubs for $4,320. At the end of the month, they had 8 sets of golf clubs on hand, and they have to pick an inventory cost method. And we have to calculate cost of goods sold and ending inventory under all 3 methods. So we're going to just dig in. First question, we've got lots of intermediate steps to do before we can answer those questions. The first question applies to all 3 methods. We need the information for all 3 methods. The first question is, how many units were sold? Now, so we have not yet tackled A, B, or C. We need this information regardless of that. So how we're going to answer this question is that beginning structure where we said that page of the inventory formulas, we need that to do what we're doing. So we're going to take our beginning inventory plus what we purchased, gives us available, and then we can subtract out our ending inventory to get cost of goods sold. So we are using those formulas. I just shortcutted it here so we didn't have as much to write. But anytime I want to solve for number sold, I'll take beginning inventory plus how many I purchased minus my ending inventory. And again, I'm dealing with only number of units at this point. I'm not dealing with total dollars. If I take my beginning inventory plus my purchase, I get 36. So I know I had 36 sets of golf clubs. I have 8 left. So if I take the 8 away, I end up with 28 sold, I believe. Yes. Okay. So again, this is not any statement I'm doing. I'm simply calculating a piece of information I need to go forward. I know from talking this morning, I know that my beginning inventory plus my purchase has to equal my ending inventory plus my sold. In this case, 9 plus 27 is 36. 8 plus 28 is 36 as well. Okay? That's all that means is that every unit that I sold had to either come from beginning inventory plus or what I purchased. Every unit in ending inventory had to come from one of those places. If I have a unit that's in beginning inventory or purchased, it has to end up in either ending inventory or it has to end up sold. Okay? So those are the basic fundamental concepts that the rest of this is built on. Okay, now this problem in our t-shirt example, I told you the cost per t-shirt was $10 or $15. This example doesn't tell us that. We have to do a little bit of work to get to it. So what I'm doing is I'm figuring out some basic data. What I'm doing now applies to both A, B, and C, to all three. So I'm still not answering a specific question. I'm doing some background work. So I'm going to take the purchase, those 9 sets of golf clubs, the 1,350, divide by 9 sets, that gives me $150. Those ones in beginning inventory cost me $150 each. Okay. Moving down, we purchased 27 sets of clubs for $4,320. So what I'm doing next is I'm going to say, well, how much did those 27 clubs cost each set? So I'm going to take the 4,320 and divide by 27 clubs, 27 sets, and I get 160 on that. So all I'm doing now is I'm building the basic data set. In this exercise, I'm going through all the steps because we're going to apply these same steps to future problems. So that's why we're going through carefully, step by step, where we get these numbers. Okay. Now, beginning inventory, we know how much it cost. We know how much what we purchased cost. Our challenge here is saying how much is in ending inventory and how much is sold. That we don't know. And that's where we have to apply a cost assumption to. And you're going to see, this is where you just take a leap of faith here. You're going to see what we're doing here, how we're going to use it in A, B, and C. We're going to use it for all three of those. Okay, so now we can finish filling out kind of this table. I guess when I approach these problems, I use a table format. And I'm going to go back, I'm going to take the 9 units at 150, give me the 1,350, 27 units at 160, gives me 4,320. Those numbers were given. I'm just solving, in this particular problem I had to solve for the per unit. And then I get my total. This 5,670 is the total cost of ending inventory plus sold units. That's that total available number. It's not connected with less ending inventory on that row. It's just the total. This is some generic information we're going to need for A, B, and C. Okay, so we just had to do some basic work to get to this. And what we have right here, we're now going to be able to do part A, and then we'll move our way down to B and C. So this is just basic information we had to calculate because we weren't given it. In some problems, we're going to be given all of this information to start with. We just needed to calculate the per unit. Okay, so we are going to go now to A, which is average cost. So we're going to round our unit cost to the nearest cent. So average cost, the first thing I'm going to do is I'm going to take the total cost. So in the left-hand corner on the bottom, I've taken my total cost. My total cost is at $5,670 that I have circled there, and we're going to divide by the total number of units. Total number of units, beginning inventory plus my purchased, the 9 plus the 27. So I'm going to divide that out, and I get an average cost per unit of $157.50. We are not done with Part A. What we've done for Part A is we've calculated the cost per unit, but they're not asking for the cost per unit. They're asking for the cost of goods sold and the ending inventory. So for Part A, still continuing here now, for ending inventory, I look and I see I have 8 units of ending inventory. We see where we have that 8 units of ending inventory. So I'm going to take 8 units times the $157.50 per unit, and that's going to give me my value of my ending inventory under the average cost method. We also need to calculate the total of cost of goods sold. The total cost of the sold units is going to be 28 units sold times the $157.50 . Okay. And now we have answered Part A. Part A is asking for the ending inventory of the 1,260 and the sold units, the cost of goods sold of $4,410. That's how, an average cost. So we're just getting our average cost and multiplying it by the number of units in ending inventory and the number of units sold. So that's Part A. Okay. Now we're moving on to B. So, and part of this is challenging, by the way, because every problem is going to be different. There's not a set standard, and this is one chapter where you really have to reason through what you have and figure out what you're missing, because it's going to be different on every problem. So now we go on to B, and B is asking us for FIFO. So the same thing, we want to get ending inventory under FIFO and cost of goods sold under FIFO. Now the first thing I do, and I do this to this day, I have been doing inventory for decades, a long time, and the first thing I do when I do an inventory problem is I write down what that method means, because it is too easy to get confused about which one we're using. So FIFO means to me that my ending inventory is my newest units. That's important for me to note. I mean, I could have just as easily noted that FIFO means my sold units are the oldest units, but I write something down that gives me something to rely on. So I'm saying FIFO means my ending inventory is my newest unit. Okay. So under FIFO, my ending inventory, I have 8 units of ending inventory, right? And we say that FIFO is our newest unit. What's our newest cost? Okay, our newest cost is not going to be in beginning inventory. It's going to be in what we just purchased. So under FIFO, for our ending inventory is the newest units. We're going to take those 8 units in ending inventory and multiply them by the $160. We're saying we're valuing those units in ending inventory at the newest cost. The newest cost is what we just purchased. So 8 units at $160. Now notice that we purchased 27 units. We only have 8 left, but we are going to value them at that newest cost, the 160. So 160 times 8 is 1280. Now we can't just say we take the oldest cost times the units sold, because some of those units we sold were from the purchased group and some were sold from the beginning inventory group. So what we can do here is we can take, if we know the total cost of ending inventory plus sold units is 5,670, that's the number circled in orange there on the right side. That is my total cost. All of that cost has to end up in ending inventory or in cost of goods sold. The 5,670 circled in orange has to end up in ending inventory or cost of goods sold. I just calculated that my ending inventory is 1,280. That means that the rest of the 5,670 has to be cost of goods sold. So my total cost of everything is 5,670. I subtract out the portion that's going to ending inventory. That will give me the cost of goods sold under FIFO of 4,390. So the answer for B, when we're talking about FIFO, under FIFO, ending inventory is 1,280. Cost of goods sold is 4,390. Now what we're doing is we're moving on to LIFO. So LIFO is going to be very similar, but the first thing I'm going to do with LIFO is I'm going to start by saying what LIFO means. LIFO means that our ending inventory are the oldest units. Okay, so LIFO. I write down LIFO, ending inventory is my oldest units. Okay, so again, my ending inventory are 8 units under LIFO. 8 units under LIFO, since it's the oldest units, my oldest unit cost me $150. So I can take the 8 units times the 150. LIFO means that my oldest units are in ending inventory, so 8 units at 150 gives me 1,200. So the 1,200 is part of the answer for C. 1,200 is the value, the cost of my ending inventory under LIFO. Now, my total cost, the $5,670, that number that's circled in orange, that's the same under all 3 methods. So my total cost is 5,670. Part of that is ending inventory value, and then the rest is cost of goods sold. So if I take my 5,670, subtract that ending inventory value of 1,200 that I just calculated, I will end up with cost of goods sold of 4,470. So again, every one of these questions, we're trying to split up that 5,670 into the 2 pieces. And we have finished this exercise. So we're done with that exercise. We are going to do more of these as we go, because each one's a little bit different. They don't all give you the information the same way, just like real life, things are different. Before we go on, we're going to do a true-false question. Okay? So this one's going to, you're going to have to think about the difference between FIFO and LIFO. The FIFO method assigns the most recent inventory cost to expense. True or false? What do you think? True? Okay. What do you think? False? False. True? False. Okay. False. What do you think?
I don't know.
You know, okay.
False.
Okay. I think I'll stop here. I'll stop at the false. What do you have? Okay, the answer is false. Oh, okay. Good. Okay. The answer is false. Now remember that sheet I gave you, or not sheet, the table this we had earlier. Okay, I gave you the slide. FIFO expense is based on the oldest units. LIFO expense is based on the newest units. So newest units are the most recent. So just using that table, that's an illustration of one way that table can help you answer questions like that. So that is a really good table to have in your notes. Next up, what I have is I have an example, and I'm going to walk through this example. So I'm going to put it up and let you write it down, and then I'm going to talk through how you get the answer. Kevin, I answered your email. Check your email for that question. What I've done on this question is I'm assuming our product, I'm just making our product be an oval with the cost on it, because then I'm going to be able to circle things and show you how I'm answering this question. And what I'm going to do right now is, what time is it? Is it 10:28? 10:26. What I'm going to do right now is I'm going to stop class right now because I want you to try this on your own, and we are going to start class on Thursday with this question, and we'll walk through it. But I think this is, I don't want to shortchange walking through the answer and just rush through it. So we are going to start here on Thursday, and I will see you on Thursday. Yeah, we will go through it on Thursday. So Rhonda, you'll have to be in suspense or be confident with your answer. So can you stop?